certainly on the trade front, this is a good development that the both sides are talking. But we are watching that risk very carefully, because this is a distinct risk to coronavirus and the healthcare damage which is happening. And we saw during the trade war that, you can get into a lot of to and fro between the two sides. And this is an election year in the U.S. And I think, as you mentioned on the market sentiment, I understand why I think this is being taken positively by the equity market. But your observation of the bond market is important as well. We are seeing the Jan contracts in Fed rates trading in negative territory, i.e. pricing some kind of negative rate, even though the Fed has been quite clear that they don't want to go into negative territory. So there is a little bit of a barbell split happening in the market space as we pass through this phase of maximum economic damage, as probably lockdowns will be eased going forward. But there is a discrepancy between these two markets at this moment in time.
My question is about the nature of the social interaction and what that means for economic activity as we come out the other side of the lockdowns, Salman, because implied in the way that we see equity markets perform, not least the Nasdaq now being positive for the year, is this sense that we just go back to this peak of activity that we saw in 2019. But I wonder how fear of strangers expresses itself actually when it comes to going to the supermarket, going to the cinema, going to any venue where you are likely to be in a crowded environment with other people. Flying, again, another example. What can we expect the new glide rate in economic activity to look like compared to where we were in 2019?
I think it's a critical question, Jeff, and I think what we are looking at is, obviously, as you rightly mentioned, these permanent or semi-permanent changes in consumer behavior. We know consumer is the driving force behind the economy, especially in the U.S. and other DM economies as well. And critically, how does that show up? This change in behavior shows up in spending patterns. Because, yes, it's well and good that the Nasdaq is up on the year, but some of these big tech names are still exposed to the size of the pie. And I can understand the argument that the share of the pie is shifting, but the size of the pie is under pressure. And critically, it's what is going to happen with these fiscal stimulus checks, which are hitting the consumer bank accounts. And if these behavioral changes lead to an increase in precautionary savings, then that fiscal stimulus is useless as well. So I think all these questions remain to be answered as we go pass through this easing of the lockdown, because at this moment in time, I would think that the market's focus is on expectations rather than any tangible or concrete observations.